Hello everyone, and welcome back. If you're new here, this channel exists for one reason only: to analyze gold and silver markets without hype, without fear narratives, and without pretending certainty where it doesn't exist. We focus on structure, not emotion, evidence, not ideology. And with that said, what happened in the silver market last Friday deserves serious attention, because it was not normal. On Friday, January the 2nd, silver exhibited a trading pattern that immediately stood out to experienced market observers, not because prices moved sharply, but because they didn't. Silver attempted multiple advances, yet every single move higher stalled in the same narrow zone, roughly between 74.50 and 74.55. Each time price approached that level, selling pressure appeared with striking consistency. This was not random volatility, it was not disorderly selling. It was precise, repeatable, and mechanical. Now here's where it becomes important to slow down and compare context. During that same time window, gold traded normally. It advanced, pulled back, consolidated, and advanced again. Exactly what you would expect in a functioning liquid market. Silver, by contrast, behaved as if it were pressing against an invisible barrier. That divergence matters, because it tells us this was not a broad metals move. It was silver-specific. Market participants noticed this in real time. Commentary surfaced on X almost immediately. Bruce Akamoto pointed out that a similar pattern had appeared in platinum toward the end of the year. He reportedly contacted LCG seeking clarification and received no response. That silence raised eyebrows, particularly among traders already sensitive to unusual metals behavior. Another trader went further, remarking that whoever was responsible for holding silver beneath that level might want to reflect on whether price manipulation is worth the consequences. The comment referenced past convictions involving former JP Morgan traders. That may sound dramatic, but it reflects something deeper, a long-standing frustration embedded in the silver market. Now let me be absolutely clear and disciplined here. I'm not accusing anyone of illegal activity in this specific instance. I do not have that information. You do not have that information. Making direct accusations without evidence is reckless and unproductive. However, silver does have a documented history of manipulation, and that history cannot be ignored when abnormal price behavior appears again. JP Morgan, among others, has paid some of the largest fines in financial history for spoofing and manipulating precious metals markets. That includes silver, gold, and platinum. That is not speculation. That is public record. When institutions with that history are active in a market, participants are justified in asking questions when price action stops behaving like a free market. At the same time, assumptions are dangerous. Not every strange chart equals manipulation. Thin liquidity, algorithmic execution, options positioning, futures market hedging, and short-term dealer flows can all create sharp resistance zones. That is why the correct approach is not accusation, but observation. Document the behavior. Track whether it repeats. Look for confirmation or invalidation. That is exactly what I intend to do. If this capping behavior persists at future levels, coincidence becomes harder to argue. If it disappears, the market may simply have absorbed temporary positioning pressure. Either way, facts will tell the story. Now, before we talk about where silver could go in 2026, we need to answer a more important question. Why is silver rising at all? Because behind the unusual price action lies a far more significant story. One that has nothing to do with charts and everything to do with structure. According to veteran metals analyst Ed Steer, what we are witnessing is not another cyclical rally. It is a structural shift in the silver market, decades in the making. In his words, what we have seen so far may only represent the earliest phase. Let's start with futures positioning. Since April, U.S. bullion banks have covered approximately 29,000 silver short contracts. That alone is meaningful. But what is unprecedented is this. For the first time on record, bullion banks are now net long silver. That is a radical departure from historical behavior. However, and this is critical, those same banks still hold a gross short position of roughly 18,000 contracts. This creates an asymmetric risk profile. If silver prices fall, their long exposure suffers. If prices rise sharply, the remaining short exposure becomes increasingly dangerous. Their flexibility is gone. Historically, bullion banks have been the entities capable of leaning on price. When their positioning flips, it signals internal stress. Now move away from paper and into physical reality, because this is where the real pressure exists. We are entering the 6th consecutive year of a structural silver supply deficit. This is not a temporary disruption. Annual demand continues to exceed annual supply. And one of the most significant developments occurred on January 1st. China implemented new export controls requiring licenses for silver shipments. That matters because China controls roughly 60% of global refined silver supply. At the same time, domestic Chinese demand continues to rise, driven by solar manufacturing, electronics, and industrial applications. The result is a tightening grip on available metal. This stress is visible in pricing. The Shanghai physical silver premium is reportedly running nearly 14% above COMEX prices. That does not happen in a balanced market. Premiums of that magnitude signal scarcity. Another crucial point, silver supply is not elastic. Most silver is produced as a byproduct of copper, lead, and zinc mining. Even a dramatic increase in silver prices does not result in an immediate surge in supply. The lag can extend for years. That is why comparisons to 1980 or 2011 are misleading. Those were leverage-driven blow-offs. What we are facing now is a structural imbalance. According to Steer, three-digit silver prices would place significant pressure on intermediaries and trading houses. At extreme levels, insolvencies become a real risk. He has even suggested that $500 silver is plausible over time, not as a spike, but potentially as a future floor. You do not need to agree with that number to understand the message. Current prices do not resolve the imbalance, they expose it. This also explains why long-term physical holders are not selling. To them, silver is not a trade. It is stored purchasing power. Now consider mining equities. Despite silver prices rising roughly 158%, many silver mining stocks have barely moved. Some are up only marginally. Historically, miners outperform the metal in bull markets. This disconnect is highly unusual. Years of cost inflation, political risk, and capital misallocation have eroded investor trust. Paper price volatility has made forecasting difficult, and generalist capital has ignored precious metals in favor of technology. Peter Schiff recently made a key observation. At some point, miners decouple from daily metal price fluctuations. What matters is future cash flow, not short-term noise. When that realization hits, repricing can be violent. Now let's talk predictions. Robert Kiyosaki continues to argue for $200 silver based on currency debasement. Gold predictors suggest a breakout above $50 opens a path toward $250 to $300. Gold Silver HQ presents extreme scenarios involving silver at 777 under systemic crisis conditions. Under normal circumstances, those numbers sound absurd. Under crisis conditions, they are less easy to dismiss. Adjusted for 1970-style inflation, precious metals have already traded at levels that would shock most people today. December 2025 may ultimately be remembered as a turning point. Silver outperformed nearly every asset class, while inventories were tight and premiums rising. Silver's dual role as monetary metal and industrial necessity makes it uniquely positioned in a world facing energy transition, supply constraints, and financial stress. This is not hype, it is structure. Silver is not moving because of excitement. It is moving because the system is under strain. And when systems strain, value migrates toward what cannot be printed. That is the signal the market is sending. Whether you listen or not is up to you. I'm interested to hear your view. Does this silver bull market still have room to run? Or are we closer to the end than most realize? Leave your thoughts below. Thank you for watching. I'll see you in the next one.
Hello everyone, welcome back. My name is Danish and this is my Money Made Simple channel. So friend, if you are new here, this channel exists for one reason only, to analyze gold and silver markets without hype, without fear, narrative. So friend, where it doesn't exist, we focus on strategy, not emotion, evidence, not ideology. So friend, and with that said, what happened in the silver market last Friday deserves serious attention because it was not normal. Okay, on Friday, January in 20 January, silver a trading pattern that immediately stood out to experienced market observes, not because prices move sharply, but because that didn't silver attempt multiple advances, yet early singles move higher stalled in the same narrow zone between 74.50 and 74.55. Each time price approached that level, ceiling pressure appeared without striking. This was not random, it was not trajectory selling. It was prices repeatable and mechanical. Now here where it becomes important to slow down and compare contrast. During that same time window, gold traded normal, it advised pull back and advanced high. So friend, this is my video. So friend, like this channel and subscribe. Sorry, like this video and subscribe my channel. Thank you so much.